Good evening, ladies and gentlemen. I'm Sumita Kareer, and this is a special broadcast. So far as the growth of the Indian economy in Q4 of FY25 is concerned, and the fresh inputs that we're getting, this is, of course, breaking right now. India's growth engine seems to be revving amidst geopolitical headwinds. So in the Jan to March quarter, the country has grown by 7.4% versus 8.4%, and this, of course, is on a year-on-year basis. Remember, this is quite crucial. This is quite critical given the fact that economists were estimating this growth to come in at around 6.8%. That's not just steady, it's resilient in a world economy that's still wobbling. We'll, of course, be getting you all the details related to manufacturing, muscle, and some of the other sectors, the services sector, and other details in just a bit. But that's the fresh breaking input that we're getting. In the Jan to March quarter, real GDP has grown by 7.4% YOY. That's on a YOY basis. In fact, I have some details on GDP forecast percentage for Q4 FY25 from several of these brokerages that we have. BOFA was projecting that figure to come in at 6.7%, CareEdge at 6.8%, ICRA at 6.9%, ICICI Securities at 6.4%. But definitely, it's a fabulous show so far as the Indian economy is concerned. And that's essentially what the Niti Aayog was also stating yesterday, that India has maintained an average GDP growth of 6.5% over a long period despite multiple shocks. And that really reflects the resilience of the Indian economy. All right, ladies and gentlemen, let's now go straight across to our guests who are joining us now. We have a stellar panel of economists and guests who are joining us to decode all of these numbers for us. We have Madan Sabnavis, the Chief Economist, Bank of Baroda. Jayesh Mehta from DSP Finance, Gaura Gupta, Chief Economist at IDFC First Bank. Thank you very much, Gaura and gentlemen, for joining us on this broadcast. Let me come to you first, Mr. Madan Sabnavis. Your first thoughts on how the Indian economy has performed. Just yesterday, Niti Aayog was stating that India has maintained an average GDP growth of 6.5% despite several geopolitical shocks that are coming in, several shocks on the energy front that are also coming in. How do you really read these numbers?
In fact, I would say it's not really surprising. There's definitely be an upside to what we were expecting. The reason being that because of the high base effect, we thought that there could be a slight moderation on an annual basis to something slightly slower than 6.5. But what we have seen here is actually very reassuring. Because we should remember one thing, that all the high frequency indicators that were coming out throughout the year had all pointed in the positive direction. Look at the PMIs, if you look at the tax collections, I think they've always been fairly buoyant. So I think this gave us some sense that the Indian economy is on this particular path of 6.5%. And quite clearly, I think this is a very good base to start off with, because once we move over into 25-26, what's really going to be critical is as to how exactly this growth rate is maintained. And we believe that we will still be in this particular range. We had an estimate of 6.4, 6.6, and I don't think we're going to change it. It's going to remain largely in the 6.5% range.
Absolutely. Mr. Sabnavis, you're stating that your estimate is going to be in the 6.5 to 6.5% range, and the government also leaves the FY GDP growth estimate unchanged at 6.5%. So that's the number that the government has also given. This is definitely stellar as compared to some of the other economies are concerned. You have the China story that's playing out at around 4%, and of course the United States that are expected to slow down. However, it's not really comparable to India, but I'm just giving a snapshot of what's happening internationally. Ms. Gupta, your overall assessment of the key growth drivers so far as the Indian economy is concerned, given the fact that we did have some pain points.
Thank you so much. So, yes, better than expected. We were at a 7%, so it came out as 7.4%. But I would still focus more on the GVA, which also was better than expected at a 6.8. The GDP has got the benefit of decline in subsidy expenditure, which is actually showing up, and hence the wedge or the gap between GVA and GDP is increased a bit. But yes, GVA definitely, which is a better metric in terms of growth, is better than expected. We were expecting a 6.4. But I would still point out that manufacturing sector growth is still, I would say, slightly better, but not that great. It's still, I would say, a little bit on the softer side. Agriculture has definitely done better. Services remains the key driver of growth. But yes, we do see some pain on the manufacturing side.
All All right, Ms. Sen Gupta, you're not too thrilled about how manufacturing has grown in the country. On that note, let me come to you, Mr. Jayesh Mehta. Mr. Mehta, let me, before asking you, a question, let me get in some more breaking inputs that we're getting. The government says that the Jan-March agri-sector growth has been at 5.5% versus 0.9% YOY. Mining sector growth stands at 2.5% versus a 0.8% YOY. Of course, manufacturing, as Ms. Sen Gupta is saying, she's not too thrilled about the number that's come out. So it's 4.8% versus 11.3%. And services sector growth has been more or less a steady 7.3% to 7.8%. How do you really see all of these numbers, and where are the pain points going forward so far as the Indian economy and many of these sectors are concerned?
To me. Hi, this for me?
Yes, Mr. Mehta.
Yeah, okay. I think, as Ms. Sen Gupta said, it's all about manufacturing, which is not really done well. But I think this quarter also we would see some improvement on the manufacturing, but I think overall services and agri, both of them would be doing better. I think from a markets perspective, I think we more focused on the headline. And headline is definitely positive from the expectation. And this will also build up the expectation for the Q1 FY26 to be higher than the expectation of the market will be maybe higher than what it was projected. I think the way we see it from the market side of it is also a lot of liquidity easing with the RBI actually did, which also impacted the last 2 months particularly. And of course, in April, May, we'll see the positive upside for that coming through. So I think it is going as per the trend. It is going as per the projection. So I wouldn't say it will be surprise, but yeah, positive surprise from an expectation will get built up for the next quarter.
Absolutely. Speaking of the next quarter, expectations are getting built up. And when you mentioned that 7.5% figure, Mr. Mehta, this is something that JP Morgan was estimating and expecting versus the other brokerages that I've mentioned, all of whom were expecting that figure to come in anywhere between 6.4% to 6.9%. But definitely 7.5% is a massive surprise coming in from the Indian economy. But looking forward, Mr. Sabnavis, what is your projection for the upcoming quarter? Given the fact that we do have the macro environment, the global macro headwinds playing out, we don't know how the trade dynamics are going to play out, the commodity prices, and of course, geopolitical risks are also could also put some pressure on energy prices as well. So what are some of the key headwinds, and what are your projections for the next quarter?
Yeah, for the next quarter, I think it's going to be fairly steady. The reason being that even though we have been talking of headwinds, we haven't really seen any of them being implemented as yet. So when I'm talking of tariffs, for example, it's something which is going to happen in the month of July. And we did see that there was some kind of hastening of exports, which we had seen in the month of April, which we'll probably see also in the month of May. So there will be a case of the external sector definitely doing slightly better than what we had expected, primarily on account of the exports front. Now, we should remember that Q1 is not typically a very hectic time as far as the economy is concerned. So therefore, I think whatever number comes out could tend to be a bit misleading, because this is just after the harvest season. So there's a bit of spending which comes in, rural spending which comes in this particular quarter on account of post-harvest come the marriage season. It's not typically the time when industrial growth really takes off. And that's one reason why we have to be a bit guarded. If you look at the core sector growth or even the IIP growth for the month of April, it's actually been very, very, I would say, it's sort of been stable, nothing really exciting happening out there. So IIP was definitely more positive. We have seen the consumer goods sector doing relatively better, notwithstanding the base effects which were there. So to my mind, I think Q1 would probably tend to be just about stable. But we need to see how the monsoon really behaves, how the agricultural harvest turns out in the months of October, November, because that's actually going to sort of lay the foundations for the growth story of the year. If we look at it from the point of view of policies, the government has done a lot in terms of the budget, but I think whatever benefits which come on tax are something which is going to get seen during the course of the year. more likely from August onwards. Interest rates have started being lowered, so we'll have to see as to how that leads to higher growth in credit. Again, we don't expect it in this particular quarter, more likely in the second half of the year. So I think the factors are all very much in place right now. And given the fact that there is a bit of tempering of what could be happening at the US level, I think the 6.4, 6.6 number, which we had earlier, looks a fair enough number for the year. Just juxtapose that with what the CA was talking of. I think no change in forecast for the full year.
Right, Mr. Sabnavis. Ms. Sengupta, let me take some of those points across to you and ask you about, one very important factor. Although the domestic drivers are intact, Mr. Sabnavis was talking about, of course, a possible rate cut. Then you also have, strong, robust domestic demand. Monsoon is expected to be good this year as well, so that is going to bode well for the rural economy. But speaking about the US economy, that's expected to have a slowdown due to various policies of the Trump administration. So what's the trickle-down impact that you forecast for the Indian economy, or do you think that the Indian economy is going to a large extent remain cushioned from that impact?
So yes, definitely we'll see some impact. Actually, even after the dialing down of the tariffs by the President Trump, there's still a negative impact that's happened on the global economy because of the uncertainty that he has created. So even though, let's say, if bilateral tariffs come down to 10% with individual bilateral deals between the US and its various trading partners, the fact that majority of the current year is over, that in itself will have a downward impact, because a lot of, let's say, corporates globally would have put their plans on hold, waiting for clarity on what would be the ultimate tariff rate. So whatever is the final tariff rate the US is able to settle with its trading partners, even if it's lower, the impact, or I would say the damage to global growth, is in a way done by the uncertainty. We do expect softer merchandise export growth for India. Services, the good part is that our services exports, which outperformed last year, is likely to be relatively less impacted by the tariff situation. But on the other hand, as you mentioned, a slowing US economy will definitely have an impact on the services sector growth. So we expect the contribution from export growth in FY26 to be lower. In fact, we expect in nominal terms merchandise export growth for India to be in negative terms. But other than that, it's not just the US situation which is posing a downside risk to our own growth. It's also, if you look at the consumption, like if you look at the expenditure numbers that have come out for Q4, you'll see private consumption expenditures actually slowed down. Now that is reflecting the urban side of the economy, which is actually softer. The good news, which I liked about Q4 GDP print, was that CapEx has actually picked up, which is a surprise, given the fact that government capital expenditure had actually slowed in Q4, at least based on the first 2 months, January, February numbers that were available from the fiscal data.
Right. Let me come to you, Mr. Mehta. Mr. Mehta, now the government has, of course, given an estimate of FY25's annual growth estimate of 6.5%. However, do you think that number going forward can be maintained due to some of these headwinds that Ms. Sengupta was also talking about, and of course on the back of that private consumption expenditure?
I think we will be able to maintain 6.5, and maybe will be, actually globally, if you look at it, would be definitely on a much better trajectory. But having said that, even if your tariff situations improve in next 1 or 2 months, it settles down, and even if it is favorable for the trade traffic to move, I think almost a quarter is wasted, and that quarter wasted, I'm talking, this is about globally, right? And that could impact the global GDP to slow down by, at least 0.25%. And that would definitely have some impact on India. And that's the reason. So I would tend to be, after seeing today's number, I would tend to be more positive to 6.5 plus upside. But because of the global slowdown, which can get, which is, like at least 1.5 quarter is actually getting wasted while people are trying to figure it out what's the tariff situation. And that's where it will impact the overall world GDP. And that's what is a little bit worrying. And and that would reflect on your risk valuations also.
Right. So, Mr. Mehta, what's the number then you're going ahead with?
No, I'm still going ahead with 6.5. Like, if there was no global tariff issue, I would have actually been a little bit more positive than the government this time around. But I would still continue to be 6.5. So that's the number I would stick to, in spite of global GDP getting slowed down by 0.25%.
Right. Mr. Sabnavis, let me come to you on that point. Now, we've spoken about GDP, but let me also touch upon GVA. I mean, this time around, GDP growth has been better than GVA. So do you anticipate for the next quarter, will this trend continue or will it reverse?
I think there would be a tendency for GVA to actually improve relative to the GDP. The reason being, if you see the difference between GVA and GDP is essentially net taxes. And in the beginning of the year, there would be a tendency for a collection of taxes, especially indirect taxes, would tend to be slower because this is a time when your consumption is not normally high. Similarly, also in terms of the subsidies, the disbursements would also tend to be slightly slower and really picks up in the course of the year. So therefore, I think this particular trend in Q1 definitely being closer to the GDP number, and there will not be this kind of wide variation. During the course of the year that you will see the GDP growth probably going ahead of GDP.
Right, Mr. Sabnavis. Let me come to you, Ms. Gaura Sen Gupta. Now, of course, all eyes are now on the rate cut trajectory that RBI is expected to follow, given the fact that inflation has softened considerably. The monsoon is going to be better than expected. There's been an early onset of the monsoon as well. So, what's the figure that you're going ahead with in terms of what the policy decision this time around by the MPC is going to be?
I am in the rate cut camp. The reason being, one, there's the risk to inflation currently are very low. For example, the RBI estimate for FY26 CPI is 4%. Our models are actually tracking somewhere between 3.5% towards 3%, because what has happened is we've had a very sharp, broad-based moderation in food inflation. And it's not just limited to the volatile vegetables. It's also seen in more sticky items such as pulses and cereals. And even now in the month of May, which is usually the period, the summer period where you actually see a sharp pickup in vegetable prices, we're still seeing a below seasonal pickup in vegetable prices, and even other, for example, pulses and cereals, they're still continuing to contract on a month-on-month basis. So actually our May CPI print is tracking at around 2.9. And so RBI has more than enough room to cut interest rates, purely looking at domestic factors, not focusing on what's happening outside, but just looking at our own inflation trajectory, which is comfortably below the 4% target. And more importantly, if you look at core inflation, which is actually the representation of demand, that has been subdued for 2 years. So that is indicating that the economy is not growing at potential. So even if we would be happy with a 6.5 number, and I agree with you, it is impressive compared to other economies, we would be one of the fastest growing economies in the world. But when you look at our inflation metrics, it's telling us that we can grow much faster. And monetary policy is growth focused. We don't have the issue that the Fed has, where they have issues on inflation. In our case, RBI in a way is relatively more comfortable. Right. They can completely focus on growth, and we do expect a 25 basis point cut in the June policy.
All right, so 25 bips cut is what you're anticipating. Quickly, let me take that across to Mr. Sabnavis and Mr. Mehta. What are you anticipating? Quick word on that, and then I'll go ahead with some of the other questions that I have.
Say that we are also looking at a 25 basis points cut.
Mr.
In fact, for the entire year, we are looking at another 50 basis points, which means by March, we should be around 5.5%. So given the target of 4%, a real interest rate of 1.5%, 5.5% would be the target rate. And RBI has given all signals that they would like to front load whatever has to be done to propel the economy so that as and when we have the busy season starting in the second half of the year, the conditions are ripe in terms of good liquidity, adequate liquidity, as well as lower interest rates. And maybe the transmission would also take place in a better manner by the time we come to September.
Right, Mr. Mehta, so Mr. Sabnavis, you're anticipating a rate cut. What about you, Mr. Mehta?
Same. June, definitely, we are anticipating a 0.25%. That's almost, markets almost priced that in. In fact, now looking at the current monsoon situation and all that, we do expect an August cut also. So, I think the rate cut would be front loaded. We will definitely go to 5.5% repo rate. And maybe, like Mr. Sabnavis said, but I would say it may happen much earlier in August itself. And then post trajectory, even on the forecast, is going a little bit higher. But at least we have a window, which is July and June and August. And in both the policies, we do expect 1% rate.
All right, so 0.25% cut is what all of you are anticipating. Let me come to you, Mr. Madan Sabnavis. Just, final thoughts on government's capital expenditure. Well, in FY25, there was a bit of a slowdown in the middle of the year. And now, in light of these geopolitical headwinds, do you anticipate that to soften, especially given the fact that defense spending is expected to go up?
No, I don't think so. I think given the fact that if we are talking of the economy growing at 6.5% in 25-26, I should tend to think that revenue generation should be very much on target. There has definitely been this positive which has come in terms of the transfer from the RBI, in terms of the dividend which is coming to the government of India. So you have that much of legroom of around 50 to 60,000 crores to take care of the contingencies in terms of the defense expenditure. So very simplistically saying, I think the government can still carry on with its capital expenditure. There's no need to compromise on it. In fact, I think the current GDP growth number should give it that much of more vigor to make sure that this 11 lakh crores of capex is expedited right from the beginning itself, because that's the only way in which we could crowd in private investment. It hasn't happened, I agree, in the last few years, but I think the government will keep trying and it will continue to do so. This year, we do not have any of those issues of elections or something which held back government expenditure. So I think that's something which will be very much on par without any compromise.
All right. Well, on that note, thank you very much, gentlemen, and Ms. Gupta for joining us and helping us decode these latest GDP numbers. Of course, the sentiment is bullish so far as the Indian economy is concerned. It is still revving the growth engine amidst geopolitical headwinds. Of course, more needs to be done so far as private expenditure is concerned for private companies. The government's growth expenditure, capital expenditure is going to continue as a plan, given the fact that, like Mr. Sabnavis said, that they're not going to be elections. So, of course, that should continue without any headwinds. Once again, thank you very much, gentlemen, and Ms. Gupta for joining us here on ET Now.